Welcome back to the channel, everyone. If you are holding NIO or even just watching the EV space, you need to hear this. We just got some critical clarification on the financial roadmap for Q4 and, more importantly, the transition into Q1 of next year. There has been a lot of noise about margins and seasonality, but we now have the numbers straight from the CFO, Stanley Chu, and the setup is looking incredibly strong. Today, we are breaking down exactly how NIO is planning to hit a massive profit target in Q4 and why the dreaded Q1 slump might not be happening the way the bears think it will. Let's start with the immediate good news. Q4 is shaping up to be a powerhouse quarter. We have analysts from Citi crunching the numbers, and the guidance is pointing to a revenue target of 34 billion renminbi. Now, revenue is great, but we care about profitability, right? The key metric here is the average selling price, or ASP. We are seeing a projected 12% jump in ASP quarter over quarter, bringing the average price of a NIO vehicle to around 246,000 renminbi. Why is that price climbing? It's not inflation, it's the product mix. Management confirmed that this surge is being driven by the high-margin flagship, the ES8. They are guiding for around 40,000 units of the ES8, with the bulk of those sales landing right now in Q4. Here is the math that should get you excited. If NIO hits that 18% gross margin target on this revenue, we are looking at roughly 6 billion renminbi in gross profit for the quarter. That is a massive injection of cash and proves that the premium strategy is working. But here is where the story gets really interesting. And this is what I want you to focus on: the Q1 outlook. Historically, Q1 is the low season for the entire auto industry in China. Sales dip, factories slow down for the holidays, and usually margins take a hit. Investors were rightfully worried that we'd see a massive drop-off after the Q4 high. But listen to what the CFO actually said. He admitted that, yes, volume will naturally be lower than the record-breaking Q4. That is expected. However, he explicitly stated that the impact this year is going to be reduced. He said, quote, "The decrease from Q4 this year to Q1 next year won't be that significant in comparison to the previous years." How are they pulling this off? It's all about the backlog. NIO has a stash of ES8 orders that couldn't be filled in Q4, orders that were quote-unquote lost to next year. These aren't lost sales. They are deferred revenue that acts as a safety net. This backlog is going to flow directly into Q1, offsetting that seasonal dip and keeping the factories humming. So, what does this mean for the margins? Stanley Chu was very transparent here. He said the vehicle gross margin will follow the volume trend. It likely won't stay at that peak Q4 level, which is normal given the lower volume. But, and this is the key takeaway, it will be better than Q1 of last year. So, the long-term trend is undeniable. We are looking at a company that is successfully shifting its mix to higher margin products, generating record gross profits in Q4, and smoothing out the volatility of Q1 with a strong order book. The thesis is intact, and the fundamentals are improving. I want to hear from you guys below. Does this reassurance about the Q1 backlog make you more confident holding through the new year? Let me know your price targets in the comments. Don't forget to like and subscribe if you want to stay ahead of the news. I'll catch you in the next video.